Good evening, everyone. Welcome to Property Feed. This is the webinar series for property finance. Today, we're joined with Mark Trayner from STAC Capital. G'day, Mark.
Hey, Dan. How you going?
Yeah, good, thanks. And
Good.
I'll be the host today from Everett Property Development Management. My name's Dan Everett. So what is Property Feed? Property Feed is your platform for building relationships in the property development industry. We connect consultants and contractors to clients, and we're essentially a forum for property development education. We typically do an in-person event and a meetup, usually on a once a month or 2 month basis. And recently we've commenced doing some webinars, and they've been great. So your event coordinators, myself, Dan Everett, and also we're joined with Caitlin Thomason. And if you want to check out any future events or webinars, just go to propertyfeed.com.au and we'll put some details there. So today's topic of discussion is all about property finance, property development finance. If you have any questions that you want fielded and answered by myself or Mark during this talk, feel free to message or send through any questions through to events@propertyfeed.com.au. So the content mentioned today is for information only, so this should not be regarded as professional advice. Panel host is myself, Dan Everett. I work with Everett Property Development Management, and we're essentially your property developer for hire. We're a consultancy. We undertake feasibility studies and assess feasibility studies for development sites, and then we look after the management of those projects. We keep the projects on time and under budget, really. We work on residential, commercial, a varied array of residential, commercial and subdivision developments throughout typically Southeast Queensland, but we also do a bit of wider Queensland reaching and also a little bit in New South Wales. We're joined by guest speaker Mark Trayner from STAC Capital. STAC Capital provide professional advice and arrangement services for debt and structured debt or equity for clients with funding needs typically between 2 to 100 million. And Mark has 19 years experience in property, business and corporate finance prior to co-founding STAC Capital in 2017. Mark held senior management roles in Macquarie Bank, NAB and private property development finance. In property finance, Mark has experience across a wide range of asset classes, including residential, from townhouses to high-density residential towers, commercial, industrial, and specialised use, such as childcare and retirement villages, through all layers of capital stack, including senior and mezzanine debt, preferential equity, and joint venture arrangements. So thanks for joining us, Mark. I hope that was a good intro for you.
Sounds good.
Topics of discussion today, and these are really picked to get some insights from Mark on the line. So what credit options are available to us? We'll talk a little bit about land acquisition finance, a bit about construction finance, and also the core part of today is to really go through some case studies. We've got one that I've been associated with currently, which we'll talk about, a subdivision, and Mark's got an array of examples with different credit options that he'll talk about as well. So I wanted to start this presentation with some definitions, and these terms are used a lot in loan agreements, credit agreements, and if you've ever ordered a valuation, I'm pretty certain it's going to say GRV or LVR somewhere throughout that valuation. So I thought we'd run through a few of these key terms. So GRV, gross realization value, is the value of the entire project upon completion. It is referred to in both excluding GST and including GST formats, and they're later commonly for reference to actual sale prices of residential properties. But for lending purposes, excluding GST is the key reference value. LVR, which is loan to value ratio, also sometimes referenced to as LTV, is the amount of debt relative to GRV, almost always excluding GST. Many lenders use this as their primary ratio in assessment of maximum lending. And then we have LCR or LTC. Loan to cost ratio compares the maximum amount of debt in a project relative to total development cost, or TDC. simply, if the LCR is 80%, then equity required is 20% of TDC. So some lenders refer to hard costs instead of TDC. Unfortunately, there is no common definition for hard costs. For some, it is only physical construction costs. For others, it includes some hard costs. And this will come pretty clear when you ever try and get a bank loan approved for construction finance. You hand them the builder's contract and they go, where's all the the consultant invoices or authority invoices? So that comes up. So Mark, did you want to touch base on any of those items? Did I cover that off well, or some of the formulas?
Yeah, covered that off well, Dan. The hard costs one, it's something that doesn't come up too often these days. Used to have a fair number of lenders that would say that they'd lend a percentage of hard costs, but everyone had a different definition of hard costs. So it's always been my little pet hate. I just hate when someone says hard costs, because it just means different things to different people. But thankfully, it doesn't come up too often these days.
Yeah, and definitely if you've got a traditional contract versus a design and construct contract, where a lot of those hard costs in a design and construct are buried within the construction value.
It's even all the little things, right? Like it's even just professionals, consultants, and even interest fees on the loan, agent commissions, pre-sale commissions, advertising fees, all those kind of things that are, they're not construction. But they are part of the costs of completing a development. Yeah.
No, that's good. So, okay, this next slide is about the capital stack. So, capital stack, we've got ordinary equity, preferential equity, mezzanine debt, and senior debt. So, over to you, Mark. Can you tell us a bit about these? I'll just stroke through these to make sure we've got all of your content on the slide.
I'll try to get through them pretty quickly. So senior debt is what most people think of as just project debt, because it's the most common. It's the first mortgage. It's the cheap stuff, or it is cheap. Certainly, if it's from a bank, there's a lot of most projects these days, certainly in the residential sector, get done with non-bank finance because the banks are just, their appetite's just too weak to be practical in most cases. Fundamentally, senior debt takes the least risk of any other type of finance. They've got the highest degree of control in general terms. Their money's the last in and the first out. So, you've got to put your money in. If there's mezz or pref equity there, their money goes in first, and then the senior debt puts their money in last. But then when sales start coming through and the money starts coming back, then they get their money at first. And so typically who the funders are for senior debt, banks have historically been the biggest funders of senior debt. But again, particularly in residential property developments, it's increasingly in the last couple of years been fund managers and just wealthy individuals. And then stepping up the stack, so then mezzanine debt, commonly known as mezz. So that's second mortgage. The term mezz, just an interesting little point. A lot of people often confuse the term mezz with non-bank senior debt. Mezz is, strictly speaking, second mortgage, sitting behind someone else. It's subordinated debt. People often refer to as mezz as just a private finance, but I guess we just call that non-bank or private. Fundamentally, it fills the gap between what the senior debt is willing to lend and how much money you actually do have or you're willing to put into a project. So it lets you do larger projects or more projects with whatever limited amount of capital that you've got to put in. One of the key points of mezz is, it really can be dangerous if it's brought in too early. We've seen a lot of cases where people have brought mezz in to a project when they're first buying the site, and whether they've got DA or not, if they're not getting straight into construction, the mezz sits there, chews its head off with high interest rates, eating away at equity, eating away at project profits, and can be pretty dangerous. If something goes wrong and your timeframes blow out or your profit margins get hit by cost blowouts, then it can very quickly make your profits disappear. Pref equity it's relatively, it's not that common, certainly not in smaller projects. It's quite common in large projects. When I say large, I'm probably talking total development costs of 30, 40 million plus. It is essentially, it's a hybrid of debt and equity. It's not true equity. Some people like to think that it's equity and it's an equity partner, but in reality, it really is debt. It's just that it often has an equity cost associated with it.
Yeah.
And that cost is usually a blend of interest and profit share. And I say usually because pref equity has so many different forms. It's sometimes it's just pure interest rate based. Sometimes it's pure profit share. Sometimes it's a mix of both. Sometimes it's just mezz with equity style securities. It can be anything. And a key point is that pref investors can have a very, very high degree of control if things go wrong. And the key bit on that is typically what's called takeover rights, which is basically where you're signing documents that if you go into default, you get forced out of the way, and the pref equity investor can take full control of the company. So yeah, it basically goes higher, gives you more money than mezz might go to, but it comes with risk. And then ordinary equity is just, that's you. That's the shareholder. That's the owner of the company. That's whoever's doing the development is the ordinary equity typically. You do take the most risk as being ordinary equity, but you should get the most reward for doing that. Put your money in first, you get your money out last, and full control in inverted commas there, because provided nothing goes wrong, you're in full control. But if something goes wrong,
yeah, sure. No, thanks, Mark. That was really insightful going through those. So let's go through a few case studies here. So this is a high-end spec home case study that Mark from STAC Capital has been involved with. This one's in Brisbane. It's a GRV of 3 million, including GST. I believe this one was a construction loan you had to organise, Mark.
Can you
tell us a bit about this?
Yeah, so I've picked a few different examples here of what we've done. And starting with this one, because this is probably a typical type of project that a lot of people, if they're getting into development, will start with projects like this. I mean, the client that does this, they actually do this on a very regular basis. This is certainly not their first project by any means, but it's a good example because a lot of people who are getting into development will start with spec homes or renovations of some sort, and they might start with by doing home loans. The home loans can be cheap and it's great, but they're also quite restrictive. You've got to meet bank policies, which these days are increasingly difficult. In this case, own a builder. So, there's not a third party contract. There's not a fixed price build contract. I'm building it. I've got a building license, and therefore, there's a certain element of risk as far as the costs go. You'll say that my budget might be $1 million, but it might, who knows? There's no contractual obligation as to that cost, so it's very easy for blowouts to happen. So banks typically don't like owner builders.
Yeah, sure. So can you just explain? So was I correct in that this was a construction loan? What about the land in this deal?
Well, it was bought as a heritage house, so pre-war house, so it couldn't be knocked over, and so I had to do a renovation of the existing house and then build additional new building out the back.
Yeah. And what did the original land look like? Did the in this instance they already had the land owned?
No, so these guys just bought it as a house on obviously Paddington, nice in a suburb, a lot of opportunity, a lot of old houses, pre-war houses. It's just a crappy old pre-war house sitting on a block in a good suburb.
Yeah. Okay. All right, I'll go on to another one now. This one's a little bit bigger development. So that was more, a single project, owner builder. So this one is a developer project. So separate builder. This is a 7-lot case study within Brisbane City Council. This is a project that I'm involved with that we're currently progressing a DA. So it's pretty much prime time to be considering marketing strategies, sales strategies, financing arrangements really right now, subject to a successful outcome with our development approval and subsequent op works and the approvals and the like. But I'll give you a scenario on this one, Mark. So this property is owned, let's say, by a trust. The GRV of land is 750K, including GST. So that's the land as is with a home on it. And that's what's saying the GRV is. Land mortgage is currently with a major bank. Most of it's been paid out, but there's currently 20% 20% left. So I've got there the loan to valuation ratio is 20% of the land. So the GRV as if complete. So we're selling all 7 lots on this example. A GRV of 2.445 million, including GST. Approximate development margin of 26.76%. So let's say I've taken this project through to development approval, and we're working through our operational works approval. So a lot of those hard costs in terms of authority fees and consultancy fees are being paid for by equity by the developer before getting you involved for construction finance. I'm thinking we're going to probably tender this and draft a construction contract ready for award at the same time of getting you involved for construction finance. No pre-sales, no marketing campaign is commenced. I guess what are your high level thoughts on this one at the moment?
So starting LVR is good. So land value as is 750. So that's, you typically don't really want to be going into these things with any more than 50% LVR. I mean, it's doable, and we've got an example coming up that's actually had more gearing than that. But under 50% against land as is certainly a good starting point. I mean, with larger projects, you typically, the ideal scenario is to have no debt on the land. The numbers work perfectly for senior debt with no land debt, but it's still doable. GRV 2.4, your development margin's good. I mean, the valuers will typically assess land value based upon about a 20% margin for projects, provided projects not multi-stage. 20% development margin is usually about where the valuers will assess the land value. There's really project like this. There's really 2 key numbers that tend to get looked at, which is, so again, that TDC, so the LTC or LCR, which is gearing against total development cost, and the gearing against GRV. Now, a small project like this, land subdivision, the focus really is more on the GRV. So it's really going to be what's percentage of, so 65 to 70% of that 2.445, although that's including GST. Most lenders will look at the number ex GST. Mm-hmm. So you've got to take into account the margin scheme on that to work your GST out. And then, so that's going to be the maximum blend, will be 65 to 70 of GRV ex GST. And then typically the way the banks will, or any lender will look at this, is wanting all of the equity in before you start funding. So look at the funding table. What's your entire FISO, and what are the costs to complete? And that's a really important thing, is cost to complete. So when you take a feasibility, so you as a DM will look at all of the project costs that are involved from start to finish. And that's important because you want to know how much profit you're making. But from a lending perspective, the really important thing is what's the cost to complete. And that should be communicated to the valuer as well, because for getting the best valuation of the site should be based upon cost to complete. So if the valuer is handed a feasibility that ignores all the costs that have been done to date and is just focused on cost to complete, that'll then give you a land value as is. Which is assumably going to be elevated because costs are out of the way and project margin is going to be higher. And then lending based upon that. So I mean, certainly at this kind of number with that kind of development margin, on the back of the envelope stuff is that you won't need any more equity put into that project.
Sufficient for senior.
Although, I mean, having said that, I'm saying that based upon a non-bank. Typically banks at this level, at this deal size, and certainly with no sales, and certainly in a post-COVID world, it's probably not likely to get a bank too excited about this, unless they're excited about something else that the client has to do.
So we've got to look at this maybe pre-sales solution to make it a bit more incentivized, or additional equity, or then some.
The thing about land subdivisions is I've very rarely seen a developer, when we look at all the pros and cons of bank versus non-bank, I've very rarely seen a developer really push for bank finance once we look at the entire FISO and all the pros and cons. And the big reason there is, even though, if you talk about a 10 or 12% interest rate, is that with small land subdivisions, the development timeframe is so short that the higher interest rate doesn't actually have that much of an effect on the bottom line.
True. You've got like 2 draws on a project like this, like especially sub fours, like small little internal roads.
The only risk with non-bank finance with a project this small is if it's going to take you a long time to get your sales.
Yeah,
okay?
true.
The product that you're selling, say it's rural residential in a location that's going to get 1 sale every 6 months, then the non-bank finance will hurt.
Yeah.
But if it's
I really like what you said about the spending, like, yes, we calculate the total costs, which we've done to understand what the development margin is of this, but then clearly articulating the cost to complete. Like, we do it on apartment developments a lot, but if you're going to go order a valuation and spend that money on a application, like, you've really got to tell them how much you've spent to date on all your consultants and authority fees, and it's really insightful. I find a lot of the times people will bypass documenting a considered program and feasibility study to know where we're at today, and just going straight to the valuer. And like you said, the valuer is just going to go, well, what is the total cost?
There's always been that saying, there's three different feasibilities. There's the one for the bank, there's the one for the valuer, and there's the real one. And there is actually, as much as that's laughed about, there is actually a good reason for that. I mean, you as a developer, you want to know what your entire feasibility looks like, because you ultimately are focused on how much profit am I actually making out of this project. But by the time it gets to the point where you're getting a valuation, there's a whole bunch of costs that you've already sunk. And the valuation, the land value as is today, is based upon what the costs are actually to complete. What you've already spent, it actually doesn't matter to the valuer. The valuer is assessing the value of the land today, which is, I've got a DA, I've spent whatever I've spent, I've done whatever works I've done, and the value of that land is based upon whatever it actually costs to complete that project. No,
that's good. Thanks, Mark. Well, let's go to, this is a 5-lot case study. This one's in Moreton Bay and Peachtree. This is a project Mark's been involved with, GRV 1.7 mil, including GST. I believe you've looked after a construction loan for this one, Mark. Can you tell us a bit about this one?
Yes. So we did this one recently, and this is probably a good example too of a relatively small project, infill. So it's taken a decent sized house block and subdivided into 5 lots. And probably the key piece here was, firstly, I mean, there's no pre-sales involved, and we've only got 5 lots, but a bank might still want to see pre-sales. And the developer had very little equity to put into this, and we're talking to the tune of only about $120,000 of real cash equity on this thing. So it was a pretty reasonable mortgage already on the site to start with. So what we did here, this was non-bank finance that we used. And so the first mortgage was done. So we talk about those gearing ratios. Typical in non-bank finance, 80% of total development costs are your LCR or LTC, or 65% LVR, so of your GRV. 80 and 65 are pretty typical numbers in the non-bank development finance space. Some will do a little bit more, some will do a little bit less, but that's typically the 2 numbers that they look at. So if I cap out at 80 of cost and that's 63 LVR, then we'll cap out at 80. If the project's got not a lot of margin, it might go the other way. It might get capped out at 80. So it's the lower of the 2. But then, so that wasn't enough with this. That wasn't going to cut it. The guy didn't have equity to put in here. So followed that up with a small second mortgage, mezzanine debt piece at an 18% rate. And so that came to a gearing ratio of 78% of LVR, so 78% of the on completion value ex GST, and 87% of total development costs. So as a percentage of total development costs, the developer only had 13% of that in hard equity. So, again, that was really only a bit over $100,000. So in this case, I mean, the interest rate on that second mortgage might sound expensive, but key piece to look at here, what we always look at is what's the weighted average cost of capital. which when you think of it, the senior debt is that big. It's relatively large at 11%, and the second mortgage is only quite small. Yeah. So even though 18% sounds small, sounds like a very high interest rate, the weighted average interest rate actually ended up only being about 13%.
Yeah. Okay.
And again, it's not cheap money, but for someone who's trying to do a project and has very little equity, they've still made a pretty decent profit. Without having very much equity. And when you looked at the return on equity for them, they did very well. They certainly well and truly more than doubled their money on that project.
And a subdivision as well, so not too, probably 3 draws on something like this, maybe 2 draws.
That's where the interest rate, as long as you can sell them and get out, the interest rate doesn't make a huge impact because you're in and out so quickly.
Let's go to another one. We've only got maybe 5 minutes, so we'll just go to a 10 apartment project that Mark's been involved with. Tell us a bit about this, Mark.
Yeah, okay. So this is pretty typical of owner-occupier targeted stock, where you've got apartments that you're selling at, call it $700,000 per unit, give or take. And typically with owner-occupier targeted stock, it's difficult to get pre-sales. I mean, in the market at the moment, post-COVID world, and I mean, this has been the case for 12 months or so, there hasn't been a lot of investors around. And investor sales are typically very expensive anyway. And owner-occupier targeted product, if you do it well, you want to be selling later on. Owner-occupiers don't like signing contracts early on. And if you do a good quality job, then it's preferable typically to sell post-completion so that buyers can walk in and touch and feel and see it and say, yeah, you have done a great job and I'm willing to pay the price that you're asking here. Yeah. And they also had a limited amount of equity. So in this, about a $6.5 million gross realisation. They didn't have pre-sales, limited amount of equity available relative to the size of the project. Yeah. So with this, again, that interest rate sitting at 11%, there's no line fee there, which is actually makes it quite cheap. One of my pet hates, I don't have time to go through it today, but one of my pet hates is the term all up finance cost, which is a bit of a bastardized term that is completely inaccurate 99% of the time. But not having a line fee there actually makes that very cheap money. But the gearing level there, 70% of GR, and 86%, so 14% of total development costs was the equity in it.
Sure. Now, thanks for providing the insights on this one, Mark. Let's go to another one of yours. So this is a bigger one. I'm just trying to get through the time, but 45 townhouses, 2-stage project, another Brisbane site, GRV 27 mil, including GST. What are your key insights on this one?
Yeah, this was an interesting one, probably in light of COVID, because this has literally been live in the last few months. And we actually had a finance approval for this development to do the entire 2 stages in one go with a pretty highly geared non-bank finance deal. And when COVID hit, the lender pulled out, which sent everything into a bit of a panic mode. And it just so happened when the deal was cut to do that non-bank finance, they only had a few sales, and so that finance deal was locked away with very limited number of pre-sales. Yeah, there were factors outside of the finance world. It was factors to do with Telstra pits and council arguments and whatever that dragged on the start date. And in that time, they got a fair number of sales, and so when that finance got pulled, we actually looked at it and said, well, we've got enough debt, we've got enough pre-sales here to be able to do a bank deal on stage 1. So we've flipped it, reduced the debt amount, significantly reduced the debt cost. And then basically what will happen here is that as they get a few more sales and we meet bank requirements to roll into stage 2, we'll then going back to the bank mid-construction saying, right, we now want to leverage up to do stage 2 whilst we're going.
Yeah, well, there was a good success with that one that the developer steamed ahead with their sales end, I think, for you. So this is our last one to talk about. This is a retail, Brisbane City Council in Stafford, GRV 3.3 mil, including GST. We've got two tenancies here, and the land was acquired as a 2-house site. What about this one, Mark?
Yeah, so this was interesting, I guess. I mean, firstly, to acquire the thing was the finance for this. It kind of sat in no man's land because it was 2 houses, zoned residential, but with an intention to develop it as a commercial development. So it's like you can't really do a home loan because the price that was paid wasn't necessarily the value of 2 houses. It wasn't too far off, but it was. There's complications in that. As soon as banks get a whiff of the fact that this maybe isn't house price value, or the highest and best use is not residential, they get a little bit nervous. So we ended up doing finance on a commercial basis to acquire the 2 things. They got a zoning for commercial use, and then started the construction. There's 2 tenancies here. So in commercial projects, you've typically got pre-commitments as far as agreements to lease instead of pre-sales in most cases. 2 tenancies here. One of them was pre-committed, and the other one is still vacant. So, there's a bit of a juggling act that goes on with banks as to meeting their hurdles, because rather than pre-sale hurdles, you've got interest coverage hurdles. So there's balancing up. Banks will want a certain LVR, but then they'll also want a certain interest coverage hurdle from the pre-committed leases. Banks at the moment, again, this has been done in the last few weeks in a post-COVID world. Most of the banks have pulled back 5 to 10% on their gearing. Commercial assets, 9 times out of 10, you want to do them with a bank because most commercial developers are developing to hold long term. So you don't want to be sitting in expensive non-bank debt unless you are selling straight away afterwards. So you want a bank to be on board, so you've got that cheap money to hold on to. So we had to play a bit of a balancing act of, well, most of the banks have pulled back 5 to 10% on their gearing levels, but we managed to get a second-tier bank client paying a little bit of an interest premium versus what the major banks would be willing to charge, but it got them a higher level of gearing, so 78% of cost. And 65% LVR based upon that, based upon 1 tenancy vacant. The deal that we've actually struck with that bank is that once they've got that second tenancy leased up and completed, that they'll leverage up to about 75% LVR, so the client can effectively cash back out.
That's a good outcome. That's a great outcome, Mark. Good project. So we've got about a minute left. Please feel free to send through any questions. We won't be able to process them through today's talk, but we will follow up with an email or a phone call. So email's on the slide. And thank you, Mark. Great talk, great insights. You want to share any sort of last thoughts and how can people reach you as well?
Well, the website's there, and if you jump on the website, my phone number and email address are there. Certainly feel free to get in touch directly with me. Look, I mean, COVID last 8 weeks has been interesting in the finance world. In the first couple of weeks we got thrown upside down. A lot of lenders literally pulled out. That included banks and non-banks who just literally closed the doors and said, we're not cutting any checks. The world's about to collapse. Australia's thankfully ended up being in a much better position, touch wood, versus the rest of the world. So there's a lot of those lenders who did run scared for the hills have come back, but everyone is being certainly a lot more careful than they were 2 months ago.
I better leave it there then. Thanks, Mark. Thank you for everyone that joined tonight. These slides will be posted on YouTube over the coming days, and please contact STAC Capital or Everett Property Development Management if you have any questions. Thanks, Mark.
Cheers, Dan. Cheers, everyone. Yeah.